Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, we got the tariff talk once again driving the markets. Some interesting news in the crypto world with the DOJ seizing some Bitcoin. So interested to hear Rob's thoughts on that. Of course, excited to interact with you all. So let's go ahead and kick off. Rob, how we doing?
Good, Zach. How are you? Welcome everyone to TradeFinder Live. Yeah, lots to talk about over the past few trading days. So let's go ahead and jump right in. Take a look at the chart of the S&P, and everyone knows what happened on Friday, where we had the midday tweet from President Trump. The market had started up. You can see there was the open. We started higher. Then it came out about putting massive tariffs on China, and down we went right into the close. And what was interesting, I've posted commentary on this, was at the close, when you have a bar like this, there was a whole bunch of sell on the close orders from institutions. Saw a big volume spike. And the way that works, if you're not familiar, is institutions are required by regulation to have a certain amount of money in cash for redemption requests, etc. And it's called forced selling because, excuse me, the institutions don't necessarily want to sell, but they have to sell because they have to maintain that cash ratio. And then the question that I opined over the weekend would be, what would the institutions do on Monday? Because then we got another tweet from President Trump on Sunday evening saying, don't worry about China. We'll get it all figured out. Everything's going to be fine. And so we got yesterday's bounce. If I add volume on here, you can see the bounce was solid volume, but quite a bit lower than the volume on Friday. But a lot of that, again, had to do with that forced selling that came in right at the close. And then today we are rallying back to the upside. But can we get back above the 10-day moving average on the close? That's what I'll be looking for today. We apparently can have a no harm, no foul, but then China came back and said, well, if we get agreement, great. If not, they came back with a negative one. They had an opportunity to kind of follow along with President Trump's, we'll work things out. And it's all posturing, really. It's political posturing between the countries. It doesn't serve either country well. We're the consumption engine. China makes a lot of stuff. They need us. So it is all posturing, and China's playing the one card they have with the rare earth metals and minerals that they have. But we've held the 50-day moving average. One thing that this move down has done, though, is created a lot of downdrafts in some stocks that have had nice runs, some that have had poor runs, etc. And that opens up a great opportunity from trading. And the timing of this is spot on. We have a free event that I'd like to invite everyone to tomorrow evening at 8 p.m. Eastern Time, called Generating Income from Trading. And I want to clarify that this is not dividend investing. This is trading for income. So it's not investing for income, it's trading for income. And when we have a little bit of a higher move up here in the VIX, elevated VIX means elevated premiums to create these income strategies. It will be held by myself and Jeff Beamer, both of us, each of us with over 25 years of experience. Jeff's actually run a hedge fund before, and we'll talk about what professional traders do. I know income-based strategies aren't quite as sexy as directional strategies, but it's what professional traders do, and it's how they maintain a trading life for 25 plus years. You always have part of your portfolio in directional strategies, but the successful money managers, the ones that have been around for a long time, also have a good part of their portfolio in these income strategies that can withstand and even profit from these kind of volatile moves, downdraft moves, etc. So I'm going to ask Zach to put that link in the chat box or Q&A. I'm not sure he runs that side of things. He'll put it where it's best, but love to have you sign up. Again, it's free tomorrow night at 8 p.m. Eastern time. If you can't make the live event, you can get the recording by registering. But it's couldn't be better timing for this with this kind of move to the downside. Perhaps we hold here and we move back to the upside. That's okay. We have the excess premium in the markets right now because of this. We've had an elevated VIX for a while, so the strategies have been good for a while, but now it's even more elevated. And if we go higher in the markets, that just means that that premium comes out, and that's perfect. You can profit from volatility coming out, IV therefore coming out of the options, or just simply profiting from time, letting time go by. So couldn't be a better opportunity for you to learn how professional money managers manage their portfolio. So once again, tomorrow night at 8 p.m. Eastern time, love to see you there. But for today, back for where we are right now, we did have that previous zigzag that hit its 61.8% level. And then all in one day, all on Friday, followed the rules of hitting it was a 38.2% B wave correction right there. And then it hit the 61.8% extension. And when you have a zigzag complete, you retrace the C wave. And it did it all in one day. We hit the target and then did the full retracement. That doesn't happen very often. So we do have a new qualified zigzag with a 50% correction here and holding the 50-day moving average, at least for now. And if it is no harm, no foul, everything moves back to the upside. Chairman Powell is speaking right now. He's pretty jovial, or he was right when we came on the air. And it seems that those next two rate cuts are going to occur between now and the end of the year. One in October, one in December is what's priced in. And if he were to hint that perhaps we could get an extra one, that could be a catalyst for the markets to move higher. But if, and I repeat, if we get back above the 10-day moving average, then the next step to make this from a qualified to a confirmed zigzag is to take out this A wave high. We're still in a wave three. So I'm going to go ahead and take this zigzag off so you can see the wave three is still active, still labeled green by the software, the Hub software, which you can get for free at hub.com, along with free L8 wave signals. You have the opportunity to subscribe to the AI signals if you want, but you don't have to get the software for free. And the algorithm is programmed exactly as Ralph Nelson Elliott wrote it. But to confirm this zigzag, we need to take out this high. So it is qualified now. That would be the confirmation. And then as you saw the target, we would be up somewhere around the 690 area if that does indeed occur. But as I mentioned over the weekend, Monday, I also had a live event for our subscribers at evotrader.com. And I mentioned that the last hour of trade on Monday would be interesting because with all these sell on the close orders that the institutions had to raise cash, and then we get a bounce. So some of that, some of the people with leverage, et cetera, may have moved out of call situations. Would the institutions then turn around and put that right back to work? Or would they just kind of hold it and let's see what happens? Well, the hold it and see what happens is kind of where the mode was because the last hour of trade, we had an upward move, we had a downward move, but at the end of the close, we basically had a pricing in the markets exactly where we were when the last hour started. So some were buying, some were not. And then we opened lower today because of that China response. where they didn't necessarily agree that everything is going to be okay and rosy. But we've been rallying since then, and we're still moving to the upside at this point in time. So, once again, the last hour is going to be important. Do the institutions buy into this early rally bounce that we're having today and put that money back to work? We'll find out in the last hour, and we can update you on that tomorrow night. So let's see what happens in the last hour today. But for now, at least the 50-day moving average has held. So we've tested it twice, the lows on Friday, the lows today, and then we'll see where we go from there. Also want to see where the volume ends up in the day, and the volume will be changed dramatically in the last hour. So we can't really pay too much attention to what's going on with volume right now. At this moment in time, going back to the chart of the VIX, we are at 19 and a half. So still elevated volatility. So we're just below this 20 level right now as I'm speaking to you. And you can see that it was an upside breakout from this triangle. The concerning part here is the breakout was not enough to satisfy the mouth of the width of the triangle. So I've told you and mention this as oftentimes as I can because there's so much misinformation out there on the internet. A descending triangle does not mean a downside breakout. There's rules that triangles should break to the sideways line, in other words, down. In this case, none of that is true. The data shows, and we backed it up by the data scientists, the AI people with Hub, that any triangle can break any direction. It may move a little bit one way to the other of the 50-50 line over periods of time, whether you're in an uptrending or downtrending market. But in general, any triangle can break either direction. So when you look at this, clearly we had a breakout there on Friday to the upside, but we haven't taken out that 22 and a half level, which is where resistance lies. Maybe that's all we get, but it doesn't satisfy the width of the mouth of the triangle. That would suggest that there could be more volatility coming in to the market, but so far resistance is held, and we'll just have to wait and see over the next couple of trading days how that plays out. Wanted to go directly to the bond market. The bond market was closed yesterday, so there was a lot of opinions on the open this morning when the market opened lower because of China's response. Then is there going to be a rush of money into the bond market? And it hasn't really occurred. We've had a breakout to the upside of this triangle. As a reminder, this is TLT, so this is prices on the 20-year. And I'll show you the TNX as well. It's pretty similar. Rates are down across the curve, the yield curve. So what we'd like to see, and the fly in the ointment, is the Fed's balance sheet. And Chairman Powell basically said they're going to be looking at their balance sheet because they've been withdrawing liquidity based on reducing their balance sheet. Now they feel like maybe they're a little bit heavier on the long end. So there's still going to be some liquidity issues going back and forth from the Federal Reserve that could affect the markets. Liquidity basically drives the markets. So a little bit of a bounce higher in prices and therefore down in yields. And if we continue to move up, that's okay. Yields and rates coming down is kind of what the market wants. It's supportive for equities, but it's much better if we have lower rates on the shorter end of the curve and higher rates on the longer end of the curve. It's called a steep yield curve or a steepening of the yield curve. Right now, rates have been coming down across the maturities on the yield curve in bonds and treasuries, and that keeps the yield curve flat. And a flat yield curve does not indicate economy as healthy as a steep yield curve does. You should earn a higher interest rate for holding a bond or a treasury longer, and right now they're about the same. But at this point, we do have a pretty symmetrical five-wave pattern to the downside here on the TNX. And as a reminder, TNX is actually rates on the 10-year. So TLT shows prices on the 20-year, TNX shows rates on the 10-year. And you can see this wave five down here. I'd be surprised if we go down that far, but we might. The pattern is pretty hard to ignore. I do like symmetry when it comes to an LA wave pattern, a zigzag, whatever, even triangles. I like them to be in symmetry, whether it's a symmetrical, ascending, or descending triangle. So if we continue down in rates on the 10-year, that could be a really good thing if we can hold rates on the longer end of the curve. So far, we haven't done that. Again, rates have come down across the curve. And I know I'm spending a lot of time on the bond market right now, but I've always mentioned that to be a good equities trader or derivatives on equities, i.e. options, you need to have at least a working knowledge of the bond market. You don't have to be any sort of a bond expert, but have a working knowledge of what's going on in the bond market because there's so much money in the bond market, more than there is in the equities market. A lot of really smart traders there. And so a lot of times the equities market will take its cue from the bond market. The dollar got a little bit of a bounce to the upside. Can we continue? We formed a triangle here. We've been in this Goldilocks channel here for quite some time, which is supportive of the equities market as far as moving higher. If you want the markets to move higher, this is supportive. We could have a little bit more of a movement to the upside out of the dollar here as well. Hard to imagine that the dollar keeps going up if rates go down. Seems like that would bring this back down. But if we have some global uncertainty, and it's interesting when I go back to the chart of the VIX, I've been talking about all the things that could create this breakout of the consolidating descending triangle here in the VIX. Is it going to be a black swan event? Is the Fed going to disappoint the market and not cut in October? What is going to be the driving factor that moves this VIX back to the upside? And lo and behold, it was the same thing that happened back in April, which were tariff tweets or posts, if you will. And that's what caused this move down here from, quote, Liberation Day, and then back to the upside. And then this correction, whether it's anything more than what it's been or just a test of the 50-day moving average, was once again created by tariffs. I think it was an excuse for people to take some profits. We've had an awful lot of stocks that are way overvalued from their historical norms. And when you go back, there's been so many talking heads. Everybody's given their opinion on the financial networks and lots of comparisons to 1999 and the dot-com bubble, et cetera. Is this an AI bubble that's forming? Most people feel that we're not quite in bubble stage yet. And who's to know if we aren't moving into an area of new or an era of new higher valuations. But the historical norms exist for a reason because they've worked and stood the test of time. So when I hear, oh, it's different this time, it's usually not different this time. So there's still a lot to be cautious about. But if you're bullish, as long as we hold that 50-day moving average, you stay bullish. And if you're looking to put new capital to work on the long side, the old buy the dip mentality, you could do that. That would be very aggressive, speculative. The more conservative approach would be, let's let the market show us that they can rebound enough to take out this wave three high right there at the 675 level. Then we likely have more to go to the upside, possibly up to that 690 level that I mentioned from the new zigzag. And we'll just have to let the markets tell us what to do. So again, everybody has a different risk tolerance mindset. You have to know what your own is. Are you willing to take risk? You're willing to put speculative money to work? Or are you I'd rather just wait. I'm a little more conservative minded and see if we can break that 675 level. Then you have plenty of room to the upside there, likely through the end of the year. If we're able to break through this now, we probably continue to drift up at least into the end of the year. It's normally a historical bullish season. But August and September are normally rough areas, and we managed to move higher throughout August and September. So historical norms don't always work. Nothing always works. Nothing is 100%. All right, so let's move into what's going on in the metals space. We'll come back and look at the rest of the markets in a minute, but gold just seems to have no ceiling. We're way above where I thought we would go. This vertical move has been in place for quite some time. It's in the nosebleed area. Basically, we've gone so vertical for so long, and that always makes me nervous when you see something go vertically like that, because you know the phrase by now, what goes vertically up oftentimes comes vertically back down. But for now, we're moving higher. We continue these little short 1 to 2 day consolidations. We've had several of them here. The last longer term consolidation we had was right at the AI's target on GLD. We had a triangle breakout here that which we caught in our portfolio. We got this right. We were on the call side. And then the AI came out and said, "Oh, you're going even higher," but we did exit following the triangle rules. The AI was right. We pegged there for about 2 weeks of trading, and then it's been virtually gap up, vertical moves, a day or two of consolidation, and another gap up. That's been the MO ever since then. Now we're starting to get pretty vertical on the 10-day. We're getting a lot of separation between the 10 and the 50. I would start to get nervous on the metals at this point. They could go higher, but nothing goes straight up forever. And the more vertical it goes, the harder the corrections seem to be. And then we have silver playing catch up here. You can see that AI had a signal there on silver, and we're moving higher on silver as well. And so the question becomes, does silver follow suit with GLD, at least the SLV, by continuing much higher than where the AI target is? We're kind of in this area on SLV as compared to the chart of GLD. You can see there just a little bit above it. So do we continue to play catch up? In other words, could we have an extended move up in silver? I would be a little more at this point. I'm still concerned about both of them with their vertical moves, but you could certainly make a case that maybe silver can continue in more of a trajectory than GLD at this point in time. And then the wild world of cryptos have been all over the place lately between Bitcoin and Ethereum. And now that big rally that we had here to start October, there's the perfect example. Went vertically up, vertically back down. Do the metals do that as well? And so now if you're long Bitcoin, you want to see, can we hold this 60 level? This brings me back to, and that's another thing that's interesting about the generating income event with two seasoned traders that have been around a while. When I first started, I did really well in the beginning, didn't know enough to be doing what I was doing, and then gave a lot of it back, and then found a mentor, someone to educate me and share their experiences. And my personal mentor had a rule that the third time's the charm. When you tested a support or resistance level, the third test of it tends to tell you where it's going to go for the short to intermediate term after that. So in other words, we were down here at 60 at the end of August. We were down here at 60 at the end of September. Now we're back down here again. So if we can hold here and bounce, then based on the rule that he taught me, and again, nothing's 100%. So if we can bounce higher and move back up, then you would think cryptos are going to continue their ascent higher. But if on the third attempt here, we break this support level and start heading down, we're probably coming down here to 55, at least as evidenced by the BITB. I know a lot of you like IBIT. It does have weekly options. The options are very liquid in both of those Bitcoin ETFs. I do BITB on purpose now because you can see the perils of trying to trade crypto on a short-term basis. I'm not sure weeklies are where you want to be unless you are very aggressively minded and have the stomach fortitude, if you will, to handle these wild moves. So whether or not you were bearish on the way up or bullish on the way down, obviously it can cause a bit of anxiety and upset stomachs. I think that there's a lot of people that are of the belief now that we will have at some point in time in the future a digital currency. And so I think that the case long term for the cryptos is good. But for the short term, it's wild. So, putting some money in cryptos and then looking at it 5 years from now makes a lot of sense to me. But trying to trade it is quite challenging. And we are below the 50-day moving average on Ethereum at this point. We have this level of support here around 27 and a half. If we break that, we do have more support down here at 25. So there's a little bit of corridor support here. But this obviously at this point is a false breakout of this triangle. It did break out. So it was a breakout because we took out this high. But the fact that we're back down means that even though it was a breakout, it was a false breakout. So we're back down in this area. And we're just going to have to wait and see how the crypto space handles it. And people are pretty adamant on the crypto space. Some say we're going to rally into the end of the year. Others say we're going to correct into the end of the year. And whichever one of those wins, the opposite will probably occur after the first of the year. So just be kind of cautious on where you are there. This is the ETHW, which is one of the ETFs on Ethereum. There's multiple ones for Ethereum as well. We moved to energy, and boy, we got out of this on the right timing here. I was wondering with this big downward move, you've seen that natural gas. I've been through the whole supply demand scenario here. Supply is winning out. We know there's going to be increased demand for natural gas with all the data centers being built because the electrical grid won't hold them. The administration is against solar and wind, so that limits the space for energy. But there are still people that are selling the rips. I've been talking about, is the buy the dip mentality still in place? Well, the opposite of that is sell the rips. So when you have something go down and you buy it and it goes up, that's the buy the dip. But the opposite is every time you go up, you sell into it. And that's what's been happening with natural gas since March. We go up, sell into it. Every single bounce has been sold into. And then down here, we base for a while and thought, all right, because at some point in time, the sellers get exhausted. And then you get a quick move to the upside. It's the path of least resistance because the sellers are exhausted and it doesn't take a whole lot of buying to create a move up. We did get that bounce. This bounce was sold into. This one was sold into. We took the position off here, even though I felt like maybe we might make it up to 15 here to have some resistance because that was the wave 3 low. And we kind of traded through it here a little bit in July, but we didn't quite make it that high. And this is what was sent out in the alert. We were just slightly overbought short term. And the way these two bounces were sold into, it made sense to go ahead and take that position off. And on this one, when we got the timing absolutely spot on, we did have this area here of higher lows, and it looked like, okay, maybe even this bounce would hold, but no, we broke it, and now we're testing the wave 5 low in natural gas. And if we go lower from here, it's, gosh, where do we wind up? We're in the middle of the tap box here on this wave 5 to the downside. Do we come all the way down to the bottom of it? Maybe. We'll have to wait and see. And then oil is following suit, also selling down a little bit. We have a strangle on this in the volatility portfolio. And I had mentioned before, you don't know which way we're going to break out of that triangle. If we break to the downside, that would be a little more nerve-wracking. because OPEC is trying to manage their own supply demand curve for oil. They like this $75 price level, at least as evidenced by USO. And every time we had these spikes, they came in and they added production. They don't want the price of oil to get too high and drive a bunch of people into electric vehicles. So they want to keep the consumer demand there. And so they have to manage the supply demand curve. But I mentioned if we broke to the downside, and this is one of the three ways that triangles can break out. Sometimes you break out and you just run. Other times you break out, come back and test the point of the breakout, and then you head down in that direction. And then once again, like as evidenced on Ethereum, you get a false breakout where you get the breakout and the big move is actually the opposite direction. So in this case, we'll see if oil can continue lower. The AI has a target down here around 67, but it's only a 42% chance. And the reason that I said it would be a little more nerve-wracking if it broke lower, at what point does OPEC or OPEC Plus step in and then decrease production? So they've already shown their hand that they want to manage the supply demand curve. How low will they let it go before they decrease production, which probably creates a bounce in oil? So that's the thing you have to be watching for on the downward move of USO. And we will probably take profits on that before we get down as far as the potential low, which could be all the way down here around 65. You could make a case for drawing this support line up here or down here, somewhere in this 62.5 to 65 range is where oil could go. Will OPEC let it go that low? I don't know. We're just going to have to wait and find out. And then getting back to the rest of our markets, the DIA, all these charts are going to look the same, so I'm not going to spend a whole lot of time on this, and then we'll get to the Q&A. And then as we move to the Qs, having a bit of a rough day today. We did have some earnings that came out from the financial sector. That was the start of earnings today with JP Morgan, et cetera. And they kind of opened lower, even though their reports were decent. And then they've been helping to move the bounce that we've had since the opening lows. But again, we have to see what that last hour brings. All of this could be different in the last hour. And then the IWM, I think, is going to be very interesting right now because it is the most interest rate sensitive, he tried to say, of the four primary markets that we talk about. We've been through this before as well. Small caps need to borrow money. They can borrow more when rates are low. They need to grow and invest their businesses. So invest in to grow their businesses. They like it when rates are lower. That could keep a bid or maybe not as deep of a corrective move. A lot of people look at the small caps for the mentality of the market, risk on, risk off. They are viewed as being more risky. I saw the percentage. It was higher than I thought of companies in the S&P 500 that aren't profitable yet. They're small companies. They're thriving on debt. They're borrowing money. They're growing and expanding. Some of them don't make it. But it was a bit higher than what I thought. But as long as rates stay low, perhaps even from that risk mentality, you can see that we're not down to the 50-day moving average yet on the IWM. And I think that's why, because rates dropping, even though it has moved with the markets in general, maybe not as severely as the other markets have. And for a final note here, before we move to the Q&A, we still maintain a wave 3 in the SPY. We go to the Qs, and we're still in a wave 3 there. But yet when we go to the Dow and the IWM, both of those are in wave 5s. Interesting that it's lasted this long. Thought maybe Friday might create some relabeling in some of the markets. So far, it hasn't. So if we can hold in the markets and turn back and get back above these recent highs on the Dow and the IWM, do those fives relabel to wave threes. Don't have to, but normally, even though these patterns are fairly similar, again, you can see that pretty good ascent here on the Russell due to rates, even with everything else that's going on. Um, it just normally, after a bit of time, they move back into concert with each other as far as their Elliott wave labeling. All right, with that, Zach, we'll go ahead and move it to the Q&A, and then we'll do our case study consideration for today at the end.
Sounds great, Rob. Let's get right into it. Got a question here on USAR.
Yeah, I figured that was coming. Um, Talking about what was going on with the rare earth metals and minerals in China. Some of these domestic um, moves in some of these companies have been quite vertical, as you can see. It goes vertically up, oftentimes comes vertically back down. Can they hold in these areas? You can see that we're well off. We'll see where we close, but well off the lows. We opened higher, traded down, but we just got too far away from the 10-day moving average, which makes this difficult to figure out from here. If we could get some backing and filling, kind of like this. So if we could get a few days where we go sideways down here around 35 in the lower end of the range, I think a lot of this is going to depend on the rhetoric from China. We are working here domestically on increasing our own production. They are rare earth mineral rich in China, but we have a lot of them too. We just haven't taken the time because it's very expensive to mine for these. I've been doing a lot of reading about them with the fact that they've been in the news, and we have a lot of them, but they attach to other things, and it's an expensive process to clean out those minerals. And if you're wondering why are they so important, they go into a lot of technology. And so that's why China's kind of holding that over our head right now as a bargaining chip. To answer the question, that's a pretty vertical move. It's too vertical for me. I would like to see a couple days. I would love to see it come down here and spend a couple days around 35, and then I think we could have another big bounce here. Again, a lot of it's going to depend on the rhetoric, which doesn't seem like it's going to calm down anytime soon. I think eventually the U.S. and China will get things worked out, get past all this political posturing, et cetera. So you could have a little consolidation and then another spike higher in these before things get worked out. And then if it comes to an agreement that is viewed as being favorable for not just the U.S. but the rest of the world, then perhaps we move back down. But for now, that's what I would like to see: some consolidation for a day or two, somewhere around this 35 level. Let the 10-day moving average catch up, and then maybe we get another run. So I would keep a close eye on that. I wouldn't chase it today, and we could come back and see a new high tomorrow. But the fact that we opened up here and sold down and are trading somewhere in the midpoint makes me think that at least that initial move is slightly overdone just for the short term. Again, I'm talking about a couple days here. So good on you for asking that. I was figuring that was going to come up.
Thanks, Rob. Got a couple symbols for you. First one's going to be Vale, VALE.
See how that one's looking. Um, I actually think it's pronounced volley. Um, but I used to say that, and somebody corrected me one time. So I'll have to check that, Zach, and see if I'm right. But I think it's pronounced volley. And it used to have a longer name, and then they brought it down. So we're holding above the $10 level, which is key for this. You all know about the importance of the $10 price level. I've talked about it numerous times. When you have securities regulations, institutions, i.e., mutual funds, et cetera, can't hold stocks under $10 a share unless their investment objective is registered as aggressive growth. Then they can own stocks between 5 and 10. But if the stock can break above 10, then a bigger group of institutions can own them that have just growth and income as their investment objective. So it opens them up to a lot more volume. And we've had a nice move higher here. We do have an AI target. It's only 66%. So 2 out of 3 chance that we make it up here. But we got awfully close. We came back down. Maybe that's as far as we go, but the wave 3 is still active. When I see a chart like this, I want to see what the DMI is showing. The ADX is coming down, so we have to beware of whether or not these two directional indicators actually cross. Oftentimes they'll come together in what I call kiss. Looks like the negative is going to break the positive and sellers are going to take control. They come together and then they split back apart where the positive goes back up and the negative goes back down. So you want to see an actual clean cross of those two directional indicators. We're pulling back a little bit here from the previous run at the end of last week up to that target level. But that's what's creating the ADX moving lower because we've been moving higher and it was with the buyers in control. And now the buyers are weakening, and that's what's being shown, the strength of the move with the ADX. But if these two do kiss and spread back apart and we continue to move higher, then you'll probably see that ADX turn back up. For now, this one would be another one to be cautious of, and that's kind of going to be across the board. Caution is the key right now. But if you're looking for, well, where would I enter? If we can close above 11 and then look like we're going to close above it, or at least trade above it again tomorrow, then perhaps you take another shot at this. If you're already long, there's no reason to get out yet. If you're looking for an entry, that's what I look for. Can we close back above 11 and then look like we might go a little bit higher from there? But the DMI is expressing caution, as is the chart. But that $11 level is going to be the key to watch.
From there, let's go to BHP.
It's going to be really interesting when all the oil companies start to report earnings. Hang in there pretty well. The companies, I feel like the earnings are going to be pretty good because oil has stayed at that midline, which would be considered slightly elevated on the chart I showed you of USO. But what's the guidance going to be as oil starts to come back down? That's going to be key. So I feel like the earnings reports are going to be pretty decent, and a lot of attention is going to be paid to their guidance for the next quarter. There's legislation being introduced to not require companies to report every quarter anymore. A lot of people feel like there's too much manipulation with that, and it would be wild to see what happens if we lose that rule. It's probably got a difficult road ahead to get past, but for now, we're just starting the new earnings season. We did touch that AI target, was a low probability, and it took a while. That's what the AI targets do. Sometimes they go straight up and you hit the target within a few days after the alert comes out. Other times it takes some time. You can see here that we've had this pattern pretty much going back to the June low of higher lows and then moving up here. So we'll have to monitor when all the oil companies report. But as far as, I'll leave the arrow on for now. Again, if you're long, no reason to get out right now. I'd hang in there unless this 50-day moving average got broken. You can see how it closed below at 1 day. That's why we talk about you have to have a follow through or confirmation day. We didn't get it, so we came right back up. So as long as we stay above this trend line here, I think you're okay staying long. If you're looking to get in, I would want to see this high from the end of last week taken out first, and then perhaps step in. It would be very aggressive to come in at this point, especially when you're so close to the resistance level. Let's just let it play out and see what happens. But when it comes to all these oil companies, let a lot of attention is going to be paid, in my opinion, to the next quarter guidance.
Next up, we have MSTR.
Yeah, having a rough time with what's going on with Bitcoin. Changed their name to just Strategy, and with that move back down in Bitcoin affecting MSTR, there's no company more bullish. They have really leveraged their company on Bitcoin. They do think that we're going to come back higher. Decent wave five to the downside pattern here. The wave four came right up, right to the 61.8% retracement level, right to this area of resistance. And then we've moved lower, a little bit vertical on the move down. And we could get a little short-term bounce here. But keep an eye on that BITB chart. Can it hold 60? If it does, then maybe we bounce. But that's a decently formed five-wave pattern. So you have to respect the possibility that we could be heading down even lower on MicroStrategy at this point. So yeah, be cautious there. It's gonna move with Bitcoin because it's pretty much a way to play Bitcoin at this point in time, above and beyond all the rest of their business model.
From there, let's go to EXK.
EXK. Staying in the silver side of things. This I do feel that based on what happened with the GLD chart, that this is a pretty good. It would still be aggressive, but a pretty good aggressive bet here on silver playing catch up to the overbought situation of gold. But looking at this chart on its own, it's having a nice move. And I'm not too familiar with this company itself, but look where we're getting awfully close to that $10 level. So if you're in this, I would stay in it. If you're looking to get in, I would wait and let it break 10. But if it can do that, based on what's going on in the metal space, I think you would have a lot of institutions that would look very closely at stepping into this one, and you could get volume and drive it even quite a bit higher. So I like this chart. I think you stay with it, and your stop, if you are in it, would be here on a break below 8. As long as we can hold above 8, then I think you're good here. And the appeal of it possibly breaking above 10 and bringing in a new crop of institutional money would be attractive to me.
Thanks, Rob. Do you think Poet, Poet, is a long-term buy?
Let's take a look. Very similar situation to what we just looked at with EXK, almost the exact same price. Very similar chart. For the long term, you got to break 10. There are a number of institutions that have aggressive growth as their registered investment objective. So there is potential institutional ownership here. You have to look behind the scenes. The DMI looks pretty constructive. So I would just basically play the tape of what I just wrote on or just spoke on EXK. It's the exact same scenario, even to the point where 8 would be considered kind of your stop right in through here. The 10-day moving average is catching up there. And if it can break 10, it could also bring in a whole new batch of institutional money. And with the potential chasing of performance, a lot of managers have underperformed the S&P. So many people have thought that we were going to have a correction along the lines that never materialized. Is it now? Maybe not. Might be just another buy the dip scenario. We'll have to wait and see. But yeah, with some of those stocks, very similar, Poet and EXK. Um, the investment managers are going to be looking for places where they can outperform the S&P. The reason I talk about that, I've mentioned it before, but money managers make their big money on their bonuses, and their bonuses are determined on if they beat the S&P. So they make good salaries, no doubt about that. But the big money comes from the end of year bonuses if they outperform the S&P. So with a lot of them that have underperformed, they're going to be looking for stocks like Poet and EXK that may get a momentum run on a break of 10, and they can outperform the rest of the market that way. So another reason to keep an eye on stocks like that.
For XBI, it's in a wave three. Is there a projected fib level that it could uh, potentially reach?
It's interesting because biotech is normally viewed as one of the, and there's a lot of volatility in the biotech sector, not as much in the ETF, and that's what it's designed for, but in individual companies, it's wild. Uh, we did run up and hit 100. That was the AI's target, even though it didn't have a whole lot of confidence in it. It was only a 38% chance that it identified back in early September, but we got there, got above it. We're holding the 10-day moving average, and it's a defensive-minded sector, and it's a lot easier to trade the ETF in the biotech space because you're always going to have the outliers that have big crashes when some negative news comes out. There's such news-driven stocks, biotech stocks, and so pharmaceuticals as well. But um, you level out that risk by the ETF. And with the uncertainty that's in the market right now, I think this is a good place to look. As far as the question on is there a fib level, there isn't really a zigzag pattern in here. We had more of that old-fashioned stair step here where we go, we consolidate, and then we move up a little vertically, and then consolidate again, as you can see through here. That's been more of the pattern, which is not really a zigzag pattern. So unfortunately, there isn't a zigzag where I could give you a fib level on where it's likely to go. This next step was a big one. So that makes you a little bit nervous, but so far the consolidation has been pretty solid. The backing and filling here that I talk about a lot so far, at least holding that 10-day moving average. And that's what I would want to keep an eye on here is on this next step higher. Can we maintain where we are at this point, stay above the 10-day moving average? But you can see that pattern there. And it's the old-fashioned stair step. It's not really zigzag. So sorry, I can't really give you um, a definitive fib level of resistance there. But as long as the market stays a little squirrely like this, I think this will be a good place to be. If the market calms down, we take out the highs, we move up towards that 690, we may pull back a little bit more on this, maybe even come down and test the 100 level. But for now, and again, all we can do is analyze the data that we have at that moment. I wouldn't run from this at this point in time. I would stay long if I was already long.
Your thoughts on Amazon?
We looked at this one last week as well, and you're getting a bit of a pullback here. Um, there was the wave five, and when the wave five is less than 100% extension, you go back to the previous four. We're pretty much there now. So when you satisfy an LA wave pattern, uh, you have to wait and let the market tell you what the next move is. What's the impulsive move going to be, the next one following that? There's still a slight chance we could take out that 240 high, and move up to a further extension on the wave five. But it looks more like we are completing this five wave pattern here with the move back down to the previous four. If we take that out, then we definitely have. But there's a slight chance, and it's a small percentage chance, that we hold here and go back up. But we are in what would normally be a seasonally bullish time. I know, and I've actually applauded Amazon for going diversifying their business model way beyond being the number one online retailer. Uh, you're coming into the holiday season. Maybe there's a viewpoint that the season isn't going to be as strong with that B wave there because there is a zigzag on Amazon to the downside. The 100% extension lies just below the previous four, which would then confirm that that five wave pattern is over. And then we'd have to wait and see what happened there. So at this point in time, I think the most likely scenario is that we do continue to drift down in Amazon. And the only thing that changes that thesis would be a break back above where this B is. So just under 230, we would have to break back above that, but you have to lean bearish in the meantime. But it isn't a whole lot of move. It's not a big, massive move lower, just a little bit of a drift down. And then it's going to a lot depend on seasonal expectations on holiday spending.
Very well. I see we're right at time. Perhaps one more question, and then we'll head over for the case study consideration.
Sounds good.
Alrighty. Your thoughts on Bull, Bull?
Webull, they came public at an insane valuation. Um, 20 or 30 billion, I forget which one, which, they're not as widely known as some of the others, even though a lot of the retail people use them. But I think Robinhood dominates that space. So this kind of a move here was not unexpected, in my opinion. It was just impossible to get pricing to short that, but I tried. I looked at it. This makes a lot more sense. This valuation down here around 10 versus the craziness up here. People may be thinking this was another Robinhood, but it isn't. Um, and the support is going to be really key here. So, from a risk to reward standpoint, um, this one's fairly easy to call. $10 is your stop. If it breaks below 10, then the question comes in, will institutions step in and support it? They might, and we hold 10 and bounce back higher. The resistance is there at 15. If you're a far more conservative minded trader, you just want to wait and see if it can get above 15 with follow through, because we also have this series of lower highs there. And so you can see we formed that. It was pretty shallow, but a descending triangle. And we did break to the downside here. And we've broken through what could have been viewed as a next level of support at 12 and a half. So that's been taken out. So the next level now becomes 10. Can it hold 10? If it breaks below 10, then who knows how low it could go. It would have to trade down there for a while, but the institutions that do own it now would have to sell if they're not registered as being aggressive growth, and that could create some significant selling. But we're not there yet. We're still at over 11, but it does seem like it may want to come down here and test 10. We could get a bounce in the short term, bounce back up to 12 and a half and the 10-day moving average. I think at this point gives you a good short opportunity on a likely test of 10, unless we break back above 12 and a half, back above the 10-day moving average. And while we're at it, we might as well let it break the 50-day moving average. So I don't see much of a scenario to go long this yet. But if we can break above that, then maybe off and running. Maybe there's just a lot of selling after that crazy IPO price that it came out at. They came public at a really good time. So we'll have to watch that. But I think the most likely scenario is a creep back down towards that $10 level.
Thanks, Rob. And if you want to head over to the case study consideration, we can kick off there.
Yeah, we're actually going to, for maybe the first time or not very often, show a bearish alert here for a case study consideration this week. We're looking at WLY, John Wiley and Sons. I think it's prudent at this point to start at least balancing the portfolio with putting some downside trades in. If it could bounce up to 37 and a half, that would be great. I think that would be the ideal entry. The market doesn't always give you the ideal entries, but we have a AI target. It's only 65%, but again, that's a 2/3 chance that this stock works its way down to 34 and a half. So that's going to be our case study consideration. Not a real popular, sexy name, but a pretty decent looking chart setup, I think, backed by some AI data. So that's going to be the one for this week.
Well, there you have it, and we will ensure to get that posted right after this session concludes. But I do want to take this moment to highlight the event that Rob mentioned in the beginning of the session. I'm going to go ahead and drop that link to register in the chat once again for anyone that might have missed it. Definitely register and attend if you are available. Going to be lots of insightful and valuable topics covered. And as Rob mentioned, it's free to sign up, so definitely don't miss out there. But other than that, great session, Rob. I'll pass back over to you.
Sounds good. Thanks, everybody. Hopefully you signed up. Love to see you tomorrow evening at 8 p.m. I think you'll find it really interesting. Again, I know the name isn't as sexy, but it is a core part of people that have been doing this for a long time and doing it successfully and everyone should have it as part of their own trading portfolios. I firmly believe that. So again, hopefully we'll see you tomorrow night at 8 p.m. Thanks as always for spending some of your trading day with us. Just as I mentioned Sunday for yesterday, mentioned it today for the close today. Let's see what that last hour brings. It's going to be really important. So have a great rest of your